Let's go to the next tax planning, year-end tax planning strategy. Number 2, realizing losses and gains. Why is this important?
It's important because underneath non-IRA accounts, there are special tax laws that are not applicable to IRA accounts, in which you can sell off shares of an investment that you have appreciation, you have some gains, you're going to be taxed on those, but within almost every portfolio, no matter how good the markets have been, there are some losers underneath that portfolio. So if you can sell some of those losers and combine it with the profits that you had in some of your winners, then in fact you can eliminate, in some cases, or decrease the overall tax bill on that take the profit strategy. So many times people set it and forget it, and that's not a bad strategy, but from a tax standpoint, if you can take some profits off the table and reallocate, that can help your overall risk in the portfolio, but you can also decrease or eliminate those taxes by selling off some of those losers and realigning your portfolio to more appropriately align with your risk as the markets go up and down.
And I want to jump in here too, because I know what maybe some of you are thinking, right? We're saying sell off some losers to basically mitigate your gains, but everybody's always been taught not to sell low.
Right.
And so this can be an effective strategy. We are saying, hey, let's sell off some losses to mitigate the gains. But what you can do is 31 days from the sale of that losing position, you can buy back into that. So if this is a position that you are confident in that will come back up, maybe in a different environment, you can buy back that position 31 days later.
Is this where capital gains tax rates come into play? And then is that part of the strategy when you're deciding how much or how little to sell off?
Yeah, and that's why we say non-IRA accounts can be tax favored as opposed to pre-tax IRA accounts, because capital gains rates are anywhere between 0% all the way up to 20% based on your total income, as opposed to your ordinary income tax rates are going to be anywhere from 0 all the way up to 37%. So you could pay more at your ordinary income level, the IRA distributions, than you can the capital gains that you would have in this non-IRA account. So it's important to understand what type of tax implications you would have when you engage in this type of strategy, but it can be really effective, especially in a market environment like a 2020. In a 2020, we were really using this type of strategy because what happened in the first half of 2020, the markets went like this. But there were a whole lot of positions, a whole lot of stocks we were confident in long term, but the economic environment was as such, everything was going down. So we could take some profits, some long-term profits, and negate that tax bill with selling off some of the losers. But then after 31 days, we could buy those back. But what happened, there was 2 benefits there. One is you don't have to pay as much or any tax on the gains that you realized, but your portfolio didn't continue to go down with the market because the market just kept going back down. And after 31 days, you bought in that stock at a lower price. And then eventually the second half of the year, everything came back up, didn't pay a lot of tax or any tax on the gains, and you had a better position in the stocks that you liked long term.